everybody, welcome to my Daily Dose with Tim. Today is Season 1, Episode 39. As promised, today we're going to go over two deal analyses with you, and they both happen to be happening in Ontario. And thank you to some of you guys who actually asked a lot of questions about the math, and one in particular really jumped out in the sense that in Canada here, we actually have land transfer taxes in certain provinces, and I live in Alberta, and so my default mode usually is we don't actually take that into consideration when we're acquiring the properties. However, it's perfect simply because of the fact that I got two deals coming your way that we're going to quickly review the math with you. And well, hang tight. I hope you had the chance to actually review the episode from yesterday where we actually went through the numbers, and we've been building this up since basically this Tuesday this week already at this point. So that was episode 37. So make sure you go back and review that. First thing first, I'm going to jump into the first deal with you, and this is as real as it gets because as you guys can see, there's not a whole lot of production value. So the only production value that I got for you guys here usually is my handwriting and with my flip charts, okay? And I'm not also very good at drawing and apparently spelling either. You can see that actually didn't come out right the first time. Anyway, so here is a quick scenario for you, and I've already pre-populated some information too. But I just want to guide you through how I usually look at a deal, okay? So first thing first, we actually find out that the tenant buyers right now have already been pre-qualified to be able to buy up to $500,000 in 2 years. So that's actually pretty good. I mean, usually in 2 years' time, that really just means that there's a bit of a lag of either down payment or, I mean, I usually call it savings because, as we mentioned, when it comes to an option to purchase agreement, you don't really want to call it a down payment. It is an option consideration, and in this particular case, whatever it is that they have saved up, it's called the initial option consideration, okay? You don't want to give them equitable interest because at the end of the agreement, they do have the option to walk away because that's what a first right of refusal really is. However, the point is, though, whatever they have saved up, it's their skin in the game, and we're putting that towards their initial option consideration. So in 2 years' time, they've been qualified, and this could be qualified through your mortgage broker, and ideally, the mortgage broker is familiar and experienced with putting through rent-to-own or lease option cases, simply because most mortgage brokers, actually, if not every single one of them, is able to help you do the pre-qualification process. However, it is really the end game, to quote Avengers, it's really the end game that really matters. And this comes back to having access to mortgage brokers that you can actually depend on, and they will share information with you in the beginning in terms of how they can actually help you put through the deal at the very end. And by you, I really mean your tenant buyers. Remember, the end goal is always about helping the tenant buyers get to the finish line, because when we help them do that, we actually get to complete that deal. Then we help them win, we help ourselves win, our JV partners, and everybody else that's involved, okay? So $500,000 is their option to purchase. Their initial option consideration is $10,000 based on what we did yesterday. If you think about it, what that really means is if we were to build them up to 10% as their final down payment in the form of total option consideration, then that means they need to be able to show that they've saved up or put away $50,000 by the time they go in and qualify for a mortgage themselves. So what that really means is if they've got $10,000 coming in, then there is a shortfall of $40,000. And if there's a shortfall of $40,000 and they got 2 years, so that's 24 months to make up, I'm gonna use my little trusted calculator here. So what that means is $40,000 divided by 24 months is 1666.67. So as you guys know, it's in this particular case, especially if we have a minimum target to hit, which is 10%, it's better to round up than round down. So I'm gonna say 1667 right off the bat, okay? So not a whole lot more, just a few cents on every single month. then this now becomes, as we said yesterday, their monthly option consideration. The reason why we go into that direction is simply because of the fact that we want to make sure that every single project or every single property that we go into cash flows. Now, the next thing that I'm going to tell you is that what that really means is that if this property is located in a market where it's a 5% growth proven over the last 5, 10, 15 years, year after year. That's the average, okay? I know in a lot of Ontario markets, it was really, really crazy over the last few years. However, remember, we're not just doing a very short snapshots. We're doing an overall average, okay? So I just want to make sure that I got the fair market rent value here for you. So let's say this property now is in a market where it's been performing at 5%. What that means is right now the maximum purchase price that we go into on this property is $460,000. And the number that I have been given by our coach Brooke on the team is that the fair market rent right now can go for $2,200 a month. So if we want to make sure that we find out about the cash flow, well, first thing first, revenue, as we said, is fair market rent plus the monthly option consideration. So we have 3,867 in this particular case. And we also have our expenses. Okay, expenses, remember, it's about your pity payment because it's such a pity that we have to pay something to maintain a property that we hold that's spitting out cash every single month, right? Well, again, it's perspectives. So from an expense perspective, we're always talking about pity payment, so PITI. And if you remember to grab your trusted mortgage calculator, okay, my mortgage, well, Canadian mortgage app, once again, then what we're going to go into now is typing in the home price of $460,000, okay? And I already write it down here. We're forecasting that, let's say, if the investor that comes in to back this deal has the ability to qualify based on 20% down, then that means $92,000. I'm just going to write that down on the side, as you know, because what that really means is we're going to have to calculate our initial investments in a little bit, okay? So I'm just going to write down $92,000 right there for you. And so pity payment, let's keep moving. When you go into a 3.9%, and then usually we do variable, and 30-year amortization. So how that works out now is that on a monthly basis, the mortgage payment is $1,735.74. So right here, I'm gonna do 17. I'm just gonna round it up to 36. Okay. Remember, I talked about this yesterday. It's the fact that I would rather usually overestimate expenses and underestimate revenue, so that when you find that extra money, it's a happy day for everybody. Because from a investing standpoint, that can only boost your overall return. Okay, so taxes right now, based on this particular deal in the market that it's in, I've been given $200 a month on taxes, so not bad at all. And insurance is $150. Usually that means the property is probably a bit older. However, not a problem at all. It's usually move-in ready either way. So what that means now is you're gonna add it all up at this point. So total expenses, you're looking at 2,086. So your cash flow is now going to be 3,867 minus the 2,086. So now we have what? 8 and 1,781. So think about that. Think about that. There is a total cash flow of 1,781 on a monthly basis. And you're going to be cash flowing that over 24 months. Okay. Just going to double check my math quickly. So 3,867 minus the 2,086. Yep. And then times 24 months, we have 42,744 just from cash flow. Okay. Now, there are two ways, actually technically three ways, as we said, because in the beginning, they do come in with the initial option consideration money. So let's go into profit at closing right now. And at closing, we know it's basically 500,000 as we went over yesterday. I hope you can see this. You don't have to see me, doesn't matter. As long as you can see the board and hear me talk. So 500,000 minus, well, we do not own the property outright yet. So what we're looking for is, first of all, mortgage balance. So based on the calculation, we know 2 years from now, we owe $354,550, and usually we have to pay for a lawyer to close on a deal, okay? And we also have to give them back the money that they have saved up, because this is how we prove that they've actually got enough money to form their 10% down payment at the end there. And so 1667 right here times 24 months. I usually do that math backwards once again because we do some roundings, okay? So plus the initial 10,000, that means we gotta rebate them back $50,008. And last but not least, in order for us to find out the true profit at the very end, we need to figure out how much money we actually put into it, okay? So initially, we have $92,000 as down payment, and typically speaking, we need to spend about $500 each on inspection and then appraisal. So that's $1,000 right there, and $2,000 for legal fees. And in this particular case, because the property is located in Ontario, not Toronto, when you go to your calculator here, on the very first page where there's a lot of options for you to choose from, because we usually go straight into the purchase calculator. What I want to bring your attention to now is the third box right there. It says land transfer. So once you get there, you'll be able to find Ontario, first of all. The home price should already be there for you. It's not Toronto, so leave it alone. It's not a first-time buyer. There's also no non-resident speculation tax. So right off the bat, you can see it's 5675 as the land transfer tax in this particular case. And so let's add it all up. Okay, so 92,000 plus 1,000 plus 2,000 plus that, you're looking at 106,775. That is your initial investment into the deal. So right here we have 106,775. So that means at closing, this is going to be a very long one on your calculator. So let's see, 500,000 minus 354,550 minus 2,000 minus 50,008 and minus 106,775. Yep, had a feeling it was going to be a bit of a minus at the very end. Not to fret, okay? That just means that on a monthly basis, even though it looks like the cash flow is very high, what I will personally do usually is to kind of divide that by 24 months again and actually not use that and just put it aside for closing. However, again, if you're doing this professionally, it doesn't matter because you're always stacking deals. So what that means is at closing, even though you have to come up with $7,233 in extra to help close the deal, you should have access to that capital. The point is, when you add the two numbers together, you definitely have a total overall profit of $35,511. So total profit is $35,511, and that's adding this to this. Okay, now $35,511 on a property like that. Okay, what we're going to do now is $35,511 divided by the initial investment, which is $100,675, and then that is 35.27%, and it takes 2 years. So on an annual basis, you're looking at 17.6 4% on an annual basis on the return on your investment. And so this is a 2-year deal, and that's why usually the return is a bit lower, simply because of the fact that you haven't had a lot of time to actually pay down what's outstanding on the mortgage yet. However, for a lot of people, they don't mind. It's 17% return is still pretty good, and you get tenants who actually take care of the property really well, and the tenant management requirements are usually a lot less. So you do the work up front, you put the money in there, and you're good to go. And this is really usually the kind of deal that a lot of people like to do, simply because it's money in, money out quickly, and every single month they're actually getting good cash flow. So it helps them build up that passive income bucket a lot faster as well. Okay, and this deal, this is the 2-year scenario right now. The scenario that I was given also can stretch into 3-year as well. And at the end of the day, also, even though I always say that we want to do the 10%, it really depends on your tenant buyer situation. The bottom line though is, even if they are not going up to 10%, first of all, you definitely have to make sure that they're not self-employed, because that becomes a non-negotiable. Second of all, you want to make sure that there was not a foreclosure or a bankruptcy in their credit history, okay? Otherwise, it's going to be really hard not to at least hit the 10% mark, and sometimes even higher. The point that I'm making with you though is that even though at 5%, a lot of lenders will accept for principal residence, it doesn't mean that you just take it to the minimum. So what I always say is, if they're not able to hit the 10, usually you want to aim for at least 7.5% minimum, just in case there's regulation changes or any sort of unexpected situations that happen with the legality side of things, or with rule changes or regulation changes from the government. Okay, so I hope that actually clarifies a few things with you. And I know that I have a second one. However, I think I'm going to cover that tomorrow, just so that you guys can also digest this for today as well. And if you guys have any more questions in terms of the due diligence you want to do a little further, make sure that you reach out to Brooke, because this is her deal right now. I'm just leveraging her deal at the moment, because the one we've been doing just got wrapped up. So not looking for an investor at this point. So anyways, here is it for today, and tomorrow I'll come back to you with another live deal example as well, and hopefully we can cover a few other notes too. So that's it for today. Thank you so much for joining me again. Make sure you like or love, I don't know, and make sure that you share this with anybody who you think can benefit from the content. So have a great evening, everybody. I will see you tomorrow. Live well.